Hey, welcome to the fifth video in this series. So I've talked about in previous videos why I think defense is more important than offense in trading, but I kind of wanted to hammer that home a little bit and talk about why risk really is more important than reward. I'm not trying to say here that your risk should be bigger than your reward, the opposite, but that you should think about risk more than you think about the reward. And the big reason for that is for what's called drawdowns. Drawdown. And drawdown is kind of just like a fancy way of saying how much you've lost at a certain time. Like, so if we go back to these equity curves, like this period here would be a drawdown. Like that, you would measure how much you lost from there to there. And the same with here, like from there to there would be a drawdown. It could also be like, during like a single trade. Like if you got into a trade here and then it went down and before up, like that period would be like your drawdown of that trade. It's just a fancy way of saying how much you've lost at any given point of time. And of course, drawdown is normal. You're going to have periods where you're losing money. You're not always going to be making money, and your account is not always going to be increasing. But you do need to expect bad drawdowns from happening, like really bad ones, because, it's like hope for the best, expect the worst, right? Because let's say, for example, you have an $1,000 account, and you risk 2% per trade, which is a pretty conservative amount. That means you're risking $20 per trade, right? That means after 50 trades, you lose all your money, right? 50 losing trades. Now, 50 losing trades in a row is obviously very unlikely to happen, and you have to have some really, really bad luck. But there is a non-zero chance of that happening. Like, it could happen, right? So, like, the chance of that happening is X, right? The opposite isn't true. Like, there is no amount of winning streak you can have that's like, oh, you won too much money. You have to stop. You have to get out, right? There's no limit on that. So on one side you have X chance of being wiped out, and on the other side it's like infinity. You can go all the way to infinity, right? There's no stopping you. So it's not just a conceptual thing. It is a math thing. And to illustrate it a little better, I like to compare trading to being a casino. So I'll just draw a little casino, big dollar sign. No windows, obviously. Your job is to kind of try to be a casino, right? You're trying to have an edge over the players, right? That's what a casino does. The casino has an advantage no matter what game you play. Blackjack, roulette, slot machines. The casino has some kind of edge against the players. And you're trying to have that against the markets, right? But the casino doesn't just have an edge. They also have a massive bankroll. And they know that players do not. So what happens is, even if a player is winning, they know in the long run that player is eventually, if the statistics pan out, that player is eventually going to lose their money and have to leave, and the casino gets to stay there, right? Because they have that cushion. But they are prepared for really good winning streaks, or for players to have a really good winning streak. They're prepared for somebody to come in and throw in however much money on 14 black or red or whatever it is on the roulette wheel, and they make millions of dollars, and then they let it ride, and it goes again, and then they let it ride again. Like that is very unlikely, but it can happen, and the casino cannot risk going bankrupt. So if you're trying to be like the casino, you can't just have an edge. You also have to have that bankroll and to preserve that bankroll. And that's why they say it's so important to preserve your capital, because a bad streak can happen. The equivalent of somebody coming in and, winning millions and millions of dollars at a casino is the equivalent of like you getting a really shitty streak of trades. Like, it can happen. It almost likely will happen. It's almost improbable for it not to happen, right? But it's not just about being afraid of going bankrupt, of getting wiped out. It's also has to do with the level at which you get to trade. So let me just kind of draw this out to explain it a little better. Let's go back to the $1,000 account, right? And let's say you trade a little more risky and you trade 5%. You risk 5% of your account. So that would come out to $50 per trade, right? So let's say you lose 5 trades. That's not that difficult to believe, right? So 50 times 5 is obviously 250. So that means you lost $250. Now, that sucks because you lost a quarter of your account, and that's a lot of money. If your entire account is $1,000, you lost a quarter of your entire account. But what happens is now you have $750, right? And so you want to continue to risk 5%. So times 5%. Now 5% of that is $37.5. So if you have like a 1-to-1 risk reward, that means, when you lose 37.5, and when you win 37.5, right? So if you're trying to maintain a certain amount of income, or like play at a certain level where you're making a certain amount per week or month or whatever, like now it's even harder for you to do that. The flip side of that isn't true. You can go on a 5-trade winning streak and choose to keep your risk at $50. You're not forced to lower your risk. I think a lot of people, they risk too much, kind of for this reason we talked about back here, right? Remember we said, like, in this first example, you would only make $200 a month. Well, so somebody says, I don't want to make $200 a month. So what I'm going to do is, in this example, they were risking 2% of their account. They're saying, I'm going to risk 10% of my account in a trade. So my risk is going to go up to $100 per trade, right? And if I have a 2-to-1, a 1-to-2 risk reward ratio, every time I win, I make $200, right? So they feel good about that. They say, okay, now I'm making $200 a trade. I'm going to make way more money. But the problem is, if you want to make more money, the way to do it is to try to become a better trader, right? It's to try to increase your winning percentage and try to increase your risk reward. But of course, that's hard. Becoming a better trader is hard. Just dumping more money into every trade is easy. And I think that's what happens. People take the easy way out. And that's not what you want to do. I mean, if everybody's taking the easy way out, you could assume it's not how to win. So then the question becomes, how much do you risk per trade? I mean, a lot of people say 2%. You've probably heard that before. I'm not going to suggest a certain amount. That's kind of up to you. But the reality is you do need to risk something, right? You can't just, buy here, and if the price goes up, you make money. But if it goes down, nothing happens, right? You have to, that would be awesome. But you have to lose something. You have to risk losing something in order to be able to win something. So that amount is kind of up to you. I would suggest just keeping it as small as possible for all of these reasons. And to kind of leave you with an interesting study that I read recently about how bad people are at calculating risk. There was a study where they got a bunch of people and they gave them a coin toss. It was like a digital coin toss on a computer where you click and you get, heads or tails. But they told them there's a 60% chance it'll land on heads, 40% chance on tails. Right? And they were telling the truth. They weren't trying to trick them or anything. And they gave them like $100, and they said, let's see how much money you can make after like 100 spins or something. And a very sizable amount, I forget the exact percentage amount of the people being tested, lost all their money, right? And it's like, how could that even happen? Well, it would happen because they would bet $50 on it being heads, it would land tails. Then they would bet $50 again, it would land tails, and then they're out. And yes, it's unlikely, but what is 0.4 times 0.4? It's a 16% chance that would happen, that you would get tails twice in that scenario. So that's not nothing, but it's like more than 1 out of every 10 people, it'll happen to them. And so it just kind of goes to show how bad people are naturally at understanding how risk affects their upside. The most surprising part of that study was actually that people eventually started betting on tails because they would get a bunch of heads in a row, and then they think, well, there's got to be a tails coming up, at this point, and which is obviously, I think, gambler's fallacy or whatever. But people just are not good with statistics. I'll talk about that a little later in another video. But anyways, that's it for this one. I hope you like it. If you got any comments or questions, let me know, and I will see you at the next video.